losing money. Average, I make money when the market is up, is 55% of our audience. Great, I make money pretty consistently, 13%. And 1% of our audience is world class.
Yeah, that's about what I would expect. In other words, the majority of people make money in rising markets and lose money in falling markets. So the question then becomes, how do you time the market? How do you know when to play and when the sun is shining, or when it's storming, you should go indoors? And that's really the purpose of this newsletter, is to show people where the good markets to invest in and which ones to avoid. And you get that question right, and making money in the markets is like a piece of cake. A portfolio on what I see unfolding for the coming year. Equities, I think we're probably going to grind a little bit more to the upside than we have a nice down big. It's possible we may get a repeat of 2010, where we're up in the first quarter, down 2 quarters, and then up in the final quarter. The outperformers will be technology, commodities, emerging markets, railroads, and energy stocks. Bonds, the one here view here, Treasuries, corporates, and municipals, sideways and then down. I think we're making a very long-term 30-year top in Treasury bonds. We're going to be grinding around this area for a bit, and then we're going to have a sharp sell-off. Currencies, dollar may have already peaked against the euro, could peak short after that against the yen, and then you are looking for a period of many months of dollar strength. Commodities, way overbought here, don't chase. I want to buy these lower down, but not right here. We've had fantastic runs the last 6 months. Don't chase. Wait for the market to come to you. Precious metals, I see them peaking short term. You had this huge sell-off in silver 2 days ago on the margin increase. I want to buy these lower down, not here. And, of course, real estate is dying a death of 1,000 cuts. Rent, don't buy. Going forward, I see we're going to have a square root-shaped recovery, which means after the huge sell-off we had in 2008, and then the bungee cord type bounce in 2009, we're going to go sideways for a long time, possibly 5 to 10 years. And when I say sideways, GDP growth averaging only 2% versus the nearly 4% we saw in the last decade. So you have to keep that in mind when looking for which long-term positions to adopt. This is quarterly GDP going back for the last 12 years. You can see the big crash was right here. And now we're recovering, but we're not going to go at that rate that we saw for the last 10 years. We're going to go more of a sideways type move here in terms of the economy. Equities. There's only one call to make here, and that is, what is the Fed going to do? Clearly, the QE2, or quantitative easing, that Ben Bernanke is engineering has been driving all asset classes. But if you look at the price action, the most money has been pouring into the better quality assets, and the lower quality assets have been lagging behind. The better quality ones are the things I happen to like long term. Commodities, precious metals, emerging markets, emerging market debt, emerging market currencies. The lagging ones have been, guess what, U.S. stocks, which are going to see a slow GDP growth for the next 10 years, and U.S. bonds, which are trading at 50-year highs. So again, buy the cheap stuff, sell the expensive stuff. That's the rule to live by. You can take a look at the S&P 500. This shows the 50-day moving average rising up to the 200-day moving average. That's a great double top right there. So we're not going to go blasting up through to new highs anytime soon. I think we grind around here, then have a breakout, maybe go a little bit higher into the first quarter, and then we get our sell-off, especially if QE2 looks like it's winding down, is finished, or never even started in the first place. Bonds. U.S. 30-year Treasury bonds are easily the world's most overvalued asset. The last time they were this expensive was in the mid-50s. Anybody who bought then had a negative return for 30 years. So if you like negative returns for 30 years, keep your Treasury bonds. If you don't, if you want to make positive returns, sell your Treasury bonds and invest elsewhere, or don't invest. Sometimes zero is the best answer. Personally, I'm looking for this to be the great short trade of the next decade. You know, Treasury bonds could drop huge in the next 10 years. When I bought my first apartment in New York 30 years ago, I had an 18% mortgage. I think we're going to see that again. The way to play that is through an ETF called the TBT, or the Tango Bravo Tango. This is the chart for the last 2 years. This is a 200% leverage bet that Treasury bond prices will go down. So since Treasuries have been peaking, you can see the ETF is flat on its back, but we're just starting to show some bottoming action down here. And at the very least, I would expect a rally here short term up to 40, maybe then back off a bit, and then make it up to the 2010 high, which is 50. You get that trade alone right, you're talking about a 50% gain on one position. Currencies. No one seems to love Uncle Buck anymore. People have been selling the daylights out of the dollar for the last 6 months, and 95% of the street is short the dollar. That's music to my eyes because, or music to my ears, because I like going the other way. When people are 95% bullish, I want to be bearish, and vice versa. So I think we may get a little bit more dollar strength, possibly in the year end, but after that, the next big move in the dollar is up. The euro peaked last week at 142.5. It's now trading around 136 as I look at my screen, and we could make it to 132 on this run. After that, we get any rallies back into the high 130s, I'd be looking to sell those rallies. After that, by the way, the euro could be the lead currency for all markets because Europe is starting to slow down again. Their problem with sovereign debt is coming back to the fore as a concern by investors, and that's what decimated all equity markets starting last April. So we could be in for another round of that in the first quarter. Here's the chart for the euro, and let's see. This shows, as a 2-year chart, it shows a very nice long-term downtrend. I expect this to peak right around here, but stay in this very long-term downtrend. So when I say, we're trading around 136 today, we could be going down to here. The low of the year was 117. That could be a revisit, and we can get a spike or an overshoot all the way down to 110. So there's a potential 25% profit in the euro on the short side there, going long dollar, short euro. And there is an ETF that lets you do that in a leveraged way called the EUO, or the Echo Uniform Oscar. It's a 200% leveraged ETF that profits when the euro goes down against the dollar. And you can buy these things at any online broker. There's plenty of liquidity in them. Australian dollar, this was the winning trade of the year on the currency front. I got in down here at 60 cents. We got up to $1.01. We may get a little more upside in this, maybe $1.05, $1.10, but the easy money has been made. Don't chase. Look to buy this on substantial dips. maybe down to 89 or even as low as 81. We may never get back down there again, but those would be good entry points. The Japanese yen, along with the Treasury bonds, this is what my other core short of the decade. This is the new Japanese flag. Everyone wants to be short Japan. The Japanese economy is in terrible straits. They have a terrible demographic picture. I'll go into more depth in my newsletter on why all these things are important. But bottom line is, I think the yen may be reaching a 15-year peak right around here. And this is probably the most viable short-term short play out there. And the way to play this one, there's a 200% leverage short position ETF called the YCS, or the Yankee Charlie Sierra. That should do really well. This shows just the long ETF. The yen has been going up for several years. You want to be selling right around here, and the way to do it is with that ETF there, the YCS. Commodities, you want to avoid paper at all costs. Like I said, if it can be created with a printing press, avoid it, because you're facing unlimited supply. I mean, Treasury issuance is going to be huge and growing no matter which party is in power for the next several years. And so therefore you want to own commodities. We've had great runs in commodities this year, especially copper, iron ore, coal. But the one that's lagged has been oil. And long term, I think oil is going to $150 or $200. It's been lagging this year because of the double dip economic scenario, which is now being thrown in the trash can. And also because we had massive amounts of oil stored left over from the last Great Recession. So once we burn our way through that, through recovering economic growth in emerging markets, especially China, then it'll be off to the races for oil. And we did break some key technical points this week. We broke 88. We made it almost up to 90. So that is a very positive development for the oil market. Food. We have a poll, a question on this. Does anyone out there eat food? Jason, can you hear me?
Yeah, we've been running the polls as you've been going. And
okay. How many people out there eat? What was the answer to that one?
93% of the audience actually eats.
Okay. Well, to the 7% who don't eat, call me. I've got to lose 10 pounds by Christmas, or I'm in big trouble. I got to figure out how to do the not eating thing and get some definite results. I think we are setting up for a global famine long term. The green revolution is worn out. We're making people faster than food. A lot of our traditional food sources are drying up, running out of fresh water. Global warming is going to be very bad news for food. And the bottom line on this is that food prices are going to go up for the long term. I started to get my people involved in June in the food area, and we caught doubles in wheat, soybeans, and corn. Now, the only headache in the food area is that there's only one ETF that's trading so far, and that's corn, C-O-R-N, or Charlie Oscar Romeo November, and we got a 50% move in the ETF on that. There will be ETFs for wheat and soybeans coming out next year. The only way to play them directly is through the futures, which I understand most people have difficulty doing. But there's another ETF called the DBA, or the Delta Bravo Alpha, and this is the chart for the last 6 months. And again, it shows we got another 50% return on that. Short-term overbought, long-term, you want to own it, you know, preferably around the 200-day moving average. Copper, again, huge story. I've been involved since the early 80s, when early part of the 2000s when it was trading at 85 cents. We're now at $4.04, multi-year high. Overbought short-term, you want to own it long-term. Precious metals, I'm a long-term bull on gold. I have been for most of my life, really. the gold, I got people in this round in at $800. We bottomed after the crash at $750. I got people in at 800 when I saw the turn. We got as high as 1420 a few days ago. And long term, I think gold goes at least to $2,300 an ounce. It may take 3 years to get there, but that's my conservative target. And of course, there are other targets out there. 3,000, 5,000, 10,000, 50,000. You can take your pick. But the bottom line is up. Short term, we are way overbought. What's that, Jason?
We just ran the precious metals poll. Would you like to see to know the answer?
Yeah, sure. Tell me about it.
30% have gold, 33% silver, 3% in copper, 9% other, and 24% have several different types.
Well, you just told me gold's going up. Only 30% are long. Is that what you said?
That's right.
Okay, well, this thing isn't peaking until that long ratio gets up to 80 or 90%. It will take us 5 to 10 years to get to the 89% level. When you have vending machines at your gym selling gold coins, that's when you want to sell. We're a long ways away from that. So, 30% long means the other 40 to 50% have yet to buy. That makes things go up. So short term, you look at this chart here, we are way overbought. We've had a great run. We're looking at a move here since the end of July of, $350 or 30%. So that's a lot for gold. Gold is actually one of the least volatile of the precious metals. Silver is more than tripled that during that time. I've been favoring silver over gold. I basically tell people to buy everything. But we really got the turbocharger with the silver play. Real estate, rent, don't buy. I see the real estate crisis lasting another 10 years. It could lead to a secondary banking crisis, which could erupt as early as next year. That'll cut the legs out of economic growth. You'll be hearing about double dip again. House prices could have another 20% drop. I did see a question come across from Mike in Tampa Bay. Is it too late to sell your house? It is. I sold mine in 2005. I sold 4 houses in the San Francisco area then and watched them go up for another year, and everyone on the cocktail circuit was telling me how much money they were making in the real estate market, and my cleaning lady got a subprime loan and bought a house for $700,000, and I'm just saying, you wait, and now I'm renting, and I'm a happy renter, and if the toilet blocks up, I just call the landlord. No property taxes, no worries, and I take all my capital and I put it in financial markets. Instead of owning houses, I own bars of copper, bushels of wheat, barrels of oil, and stocks in emerging countries like Thailand, Chile, Colombia, South Korea, Taiwan, and so on. And the returns there have been great. So here's the final conclusion. This is what looks good today, and I'll be updating this constantly. Let's see. So equities, no trade at the moment. Everything's overbought. Bonds, sell treasuries. Corporates and municipals, keep them, but only if you can keep them to maturity, which is 10 years quite often, or 5 years. With taxes going up in the future, it does make sense for certain high net worth individuals to keep municipal bonds. Currencies, dollar, is in the process of peaking now. Could take another month or so to make a real top, but the next big move in dollar is up, and you want to be shorting the euro and the yen against it. Commodities, don't chase. We've had a great year. Wait for a big dip, a multi-month dip to get involved, preferably 20 or 30% down. and then you buy. Same with precious metals, real estate, dying a death of 1,000 cuts. And that's the presentation. Now let me go through some of the questions that have come across. Questions. Let's see. So what's more important from, let's see, this is John from Missoula, Montana. What's more important, my technical trading skills or knowing what asset to trade? It's 99% knowing what asset to trade and 1% technical skills. I only use technical analysis to give me my buy and sell points. And you can add returns to your portfolio by getting that right. And I will be providing technical buy and sell points with my recommendations. But, you want to get the ocean right before you know how to trim the sails. I'll be pointing you towards the right ocean. Actually, the right ocean is the Pacific and the Indian Ocean, if you really want to know. Question. Should I sell all my U.S. stocks right now? I would be taking profits on U.S. stocks generally. The only stocks I'm involved in are in technology, energy, oil, commodities, and rail, because you need railroads to move the coal to the West Coast so they can sell it to China. So, yeah, I would be lightening up on stocks here. I wouldn't get out of everything. I think Uncle Ben is going to continue with QE2 for a couple more months. The market's going to be discounting that. QE2 probably is 80% in the market already. If you want to hang on for the last 20%, you can, but keep stop losses under your positions, because once the turn comes, it'll be ugly. The days when people sit back and endure 50% losses in their portfolios are gone. We flip from risk on to risk off. You want to be out of there. How many stock trades should I be making in a year, says Julian in Seattle, Washington. The least amount possible. If you watch CNBC, if you listen to your broker, it's all about revving up your turnover. Get you to do something, anything. I would, I would try to do the least amount of trades possible. And, one way to do this is use the 90-10 rule. Look at all the trades you've done in the last year. Kick out 90% of them. Look at the 10% that made money, and then focus on those areas. With retail or beginning investors, they overtrade to a man. And this is partly because Wall Street wants you to overtrade, because that's where you make your money. So minimize your trades. Just do it to a few good calls a year. You'll end up making a lot more money for yourself and a lot less for your broker. Another question from in Shanghai. Should I sell all my bonds now? Yes. Sell. These bonds are ridiculously overpriced. We are in a bond bubble. Anyone who says we're not in a bond bubble is smoking something. Yes, it could continue for a few more months, or it may already be over. It's hard to tell, but I'd be really inclined to sell rallies in the 30-year Treasury bond. And as I mentioned, you can do that through the TBT. Let's see. Let's take a question from Europe. What will trigger the bond collapse? Says Graham in London, England. That's easy. The day before Ben Bernanke ends QE2 is the day you want to be out. As soon as the liquidity starts pulling out of the financial system, all assets will go down. So that's when you flip from your risk on trade to your risk off trade. When the Treasury market goes, it's going to take everything with it. And there will be great shorting trades to do. I don't short things that are in decade-long up trades. So you won't see me shorting things like copper, like the Australian dollar, like Thailand or China. You will see me sorting things like U.S. stocks, Treasury bonds, European currencies, and the yen, which are in long-term downtrends. I'm not a great counter-trend trader here, so I'm looking to have the wind at my sails, and I'm looking to sell the expensive stuff on the big rallies, buy the expensive stuff on the big dips. In the middle, I don't do very much, and we may go long periods without having a specific trade to do, because quite often nothing is the best thing to do. Again, that gets to the over-trading problem and spending the time doing research. So that's all the questions I've got. We've been at this now for about 45 minutes. My apologies in advance to the slight delay in the middle, and my apologies also to the people who were not able to attend because they had trouble getting into the site or anything like that. Jason, do you have any more questions?
No, John, why don't you just tell people your final
Yeah,
piece?
okay. Well, that's the end of my presentation today. All of you who are members of Macro Millionaire will be getting my complete watch list of trades posted in your members area soon. And, of course, you'll get all the specific trade alerts I'm telling you about, when to buy, when to sell, and why. For guests on the call-in, watch your inbox in the next few minutes, and we'll be sending you an email inviting you to take a risk-free test drive of my Macro Millionaire coaching program and trading service, where I will turn you into a world-class trader and make sure you're catching all these big moves in the market. You can find out more by going to www.macromillionaire.com. Thanks for being with us. I look forward to getting to know all of you Macro Millionaires better when we make money in the near future. Have a great day.